Welcome to AARP, Arizona Hispanic Connection. Educate. Celebrate. Connect. Arizona Hispanic Connection.
Good morning, everyone. This is AARP, Arizona Hispanic Connection. The subject today is taxes, filing taxes 101. So we are going to be, I suppose, doing our very best to explain some very complicated system of taxes that we have in our country. We have three guests today that are... Actually, all of you are retired,
Correct.
and all of you are volunteering.
Yes, sir. Yes,
And the three of you, at least in one area, which is helping folks prepare their taxes. Am I correct?
That's right.
Yes, David.
Let's start to my left. We have Irene Gomez. And Irene Gomez, you volunteer with the AARP Tax Aid Program. Welcome to our show.
Oh, thank you very much, David.
Yes,
Thank
thank
you.
you. Thank you so much. To my right, we have Consuelo Alvarado. And Consuelo, you also are volunteering with the VITA program. What is VITA? First of all, welcome. And if you can let us know what VITA is.
Good morning, David, and thank you very much. Yes, VITA stands for Volunteer Income Tax Assistance Program, and I actually work with the Mesa United Way area. So we're out in the East Valley and Mesa, East Mesa. We have several sites, and I've been doing this for a long time, and I absolutely love it.
I'm curious because all three of you are Hispanic, Latinos, and a lot of times it is not so easy to find volunteers, period, but more so on something that is kind of complicated. So first of all, thank you. I congratulate
Thank
you for
Thank you.
being versed in this issue and being willing to devote time in volunteering. Hopefully we can find more. And by the way, if you're listening to our show and you want to volunteer, I'm sure there's a lot of room for more. Also, Frank Varela. Frank Varela, you've been here before, and
Yes,
welcome.
I have. Well, thank you for having me back. It's a pleasure to be here, and
Thank you.
your show is so informative that I'm glad to be part of it.
Thank you, Frank. And you are also with the AARP Tax Aid Program.
Exactly.
And later on, as we develop the conversation, we are going to inform our audience how they can tap into this free resource. They can help you file your taxes for free, with capital letters and bolded letters, free.
Right.
I know it's not, filing taxes is not only complicated, but it can be pretty expensive. And
Yes, it
and
is,
I think
David.
these programs offer such a great...
this program does file everything electronically. We don't.
Right.
The person doesn't have to do anything.
Perfect.
And we're looking for volunteers all the time. We're trying to open the diversity sites. We just
Yes.
opened up at O'Neill Park,
Right.
and that's what we're really interested in.
Yeah,
doing.
so again, if you have some extra time that you want to use it and put it to good use, volunteering for tax aid programs in different with different companies. I mean, AARP is one, VITA is another one, but I'm sure there's tons of companies
Right.
that solicit grants from the IRS, as I
Exactly.
understand it, and then they are granted those funds, and then they set up shop, so to speak. They offer the service free of charge. They recruit volunteers, they train them,
Yes,
and then
correct.
they
Yes.
start operating. We are going to be addressing filing taxes 101 from a very basic, that's why we call it 101, from a basic concept. And we're gonna go as deep as necessary and as deep as the time allows it to. So let me start by making reading a few statements, and then I'm going to ask you to correct me if I'm wrong, because these statements pretty much tell or point to the structure of the 1040 form, which is typically used. So here we go. So the first thing that the form 1040 does is to calculate gross income. Yes or no?
Yes.
true.
Okay, so that's the
Correct.
form will calculate gross income. Second, after gross income is calculated, there are some adjustments that are made to the gross income that makes it then the adjusted gross income.
That's right.
True or false?
true.
That's true. That's
Okay, 2 for 2.
true. Okay.
Now, so in a very general sense, the adjusted gross income then becomes the taxable income in a certain sense.
In a certain sense, yes.
Yes.
It's not the final, but it
Right.
is yeah.
Yeah, maybe we can say that it is at the first stage.
Yes.
At the first stage, the adjusted gross income becomes the taxable income. So after the AGI or adjusted gross income is calculated, then there's a series of adjustments, if you will, that can lower the adjusted gross income,
Yeah,
correct?
basically. And those are deductions.
Right. So you have deductions, and that's what we all want, right? We want to have the lowest adjusted gross income possible, correct?
Right.
Because in the end, that's the tax bracket of someone belongs to, whatever that percentage means,
Right.
will be applied to the taxable amount.
Right.
Okay, good.
Yeah, the final land is a taxable amount.
Right.
At the end.
Right. So, again, gross income, adjusted gross income, then that becomes a taxable amount. But the good news that taxable amount can be reduced
Yes.
considerably. And then at some point, then you calculate the tax liability using the tax bracket that you belong to.
Correct.
Okay.
Right.
Correct, David.
Right.
Now, once you calculate your tax liability, that's not the end of the story, right?
Nope, not at
Because
all.
then you have payments that you have made during the year to that tax liability, plus some credits that you might be eligible for, and that yields another amount. I call that the reconciliation stage, right?
Exactly.
And for some, they will have underpaid. Others will have overpaid. So anybody who overpays taxes, they get a refund. Anybody who underpays then owes a payment. So that's roughly what we want to talk about
Yes.
today. And I just wanted to kind of present a summary because that's kind of like the way the 1040 is.
Right. That's a good outline. A good
Yes,
outline.
it's kind of like an outline. So let's get started. There is a section in the 1040 that is general information. It asks you for your name and this and that. But then there's another piece of it that says exemptions. Can you help us understand what this filing status and exemptions, what is the significance of those two elements?
Well, exemption is all your dependents that you are in your household that you take care of. You could use them as an exemption. That's basically what it is. Your dependents that you provide for the whole full year. It could be your grandmother, grandchild, stepchild, and so forth.
Right. Yeah, as long as you pay more than half of their cost, okay, and if you provide the housing, and even a grandma, if you have a mother, doesn't have to live with you, but that's the only relative that doesn't. As long as you pay at least half of their household, that can become an exemption.
Can you count yourself as an exemption?
Yes, definitely.
Okay.
Yeah.
Now, but what is the significance? What is this going to do?
Okay.
What is the exemptions going to do for you or for
The
who?
exemptions, every exemption means a $4,050 deduction off of your adjusted gross income. Okay, so if you have now you're looking at $20,000 that you can deduct from your taxes.
Okay. Now, does that also have any effect on how much withholding? If you reported those exemptions in the W4? I think.
W4, right.
Do you report those exemptions in the W4 or not necessarily?
Not necessarily. You can. Okay. That's all done at the start of the year. So hopefully you don't over exempt, because then you're going to owe money at the end. Okay, so what you want to do is be as close as possible to the real exemptions that you have.
Yeah, and then there's 5 status that one can have: single, married, filing jointly, married, filing separately, head of household, and qualifying widow or widower. Now, what is the significance of that? The status that you use?
So the significance of that determines what the deduction is that you're eligible for if you do not itemize. It's called the standard deduction. So the head of household standard deduction, for instance, is $9,350 this year. So again, that's a reduction of the adjusted gross income to get to that final taxable income to determine what your tax obligation is.
So these exemptions and filing status have to do with the amount of money that you're going to be able to use to reduce.
That is correct.
Reduce
That is
your
correct.
taxable amount.
Exactly.
Okay, perfect. Now, for instance, with the status, if you file by single, then you're only going to be able to deduct like $6,000 plus for standard deduction.
Exactly.
If you do it as a couple, then you do twice as much.
Pretty much, yeah.
Pretty much.
That's right.
Now, I know that there was a tax reform. So
Right.
will there be a change with the exemptions
Yes.
come next year?
Yes, the
Come next
exemptions
year.
will no longer be around.
Okay, so the tax reform double the standard deductions that a person can claim,
Pretty much, yes.
but
it takes away
eliminated
the exemptions.
the exemptions. So somebody with, they were going to use $12,000 more on the deductions, but
Right.
then if they had, like you said, five exemptions, that was $20,000
Exactly.
that they're going to lose.
That goes away. Exactly. So it all depends, and it all depends on the circumstance. Every family will be different.
Right.
Every taxpayer, like she said, it's a different situation. So you have to kind of look and see, but it's not. I know they've been announcing it's going to help everybody, but that's not necessarily so.
Not necessarily. We have about a minute before we go on the first break, but explain to us, how does an individual control, and if that person has control over how much the employer withholds money? Do you have some control of how much you want the employer to withhold?
Yeah, basically with the W-4 form.
The W-4.
Right, and then you can also add additional.
Right.
Taxes
Want to add
that
something,
come.
Consuelo, to that?
Yes, the IRS does have a calculator on their irs.gov website where you can go in and put the information that represents your current situation to determine what your new withholding should be for this tax reform. I understand it's pretty accurate.
Yeah, and it doesn't have to be perfect at first, because that's just talks about how much money they're going to withhold. But then when you do the reconciliation at the
Exactly.
very end, when you file taxes, that's the more accurate
Exactly.
numbers. So, but you do have some leverage or some control as to
Definitely,
how much
yes,
you want the government, because sometimes people want more money to be withheld so they can get a refund at the end. Others don't care,
Yeah.
and others says no, don't take a lot. There's different
We
scenarios.
were just talking about that because it's your money, whether
Right.
they take it up front or take
In
it
the end,
later.
it's pretty much the
It's
same.
the same.
It's
It's just
okay.
when do you want to give it up?
Perfect. Okay, that was just the beginning. You're listening to AARP, Arizona Hispanic Connection. We're going to go on our first break. Stay with us.
Welcome to AARP, Arizona Hispanic Connection. Educate. Celebrate. Connect. Arizona Hispanic Connection.
Thank you for staying with us. This is AARP, Arizona Hispanic Connection, with an amazing show. I love this subject. I suppose I love all the subjects because, for the most part, I select them, right? So I must love them. But let's just go straight to the issue because of time. So again, 1040 is the form that we use to file taxes. We cover a little bit of the status that you will use, the different statuses, then the exemptions. Now let's go to income. So the first thing this form from line 7 to 22 does is to calculate the gross income. What is this? What is the gross income? What is it composed of?
So your gross income can be income from wages or salaries that your employer paid, and it's gross meaning it's like the amount that you get paid per hour, for instance, before any taxes or any deductions for insurance or anything that you have to pay. It can also be income from a self-employed person, someone who works either as a contract employee for an employer or works for themselves. So the income that they make before any deductions is considered the gross income.
And if somebody, when they have the form, line 10 to 22, I mean, it has capital gain, business income, alimony received, taxable refunds, credits, qualified dividends, ordinary dividends, rental, like if somebody rents a house and makes money of it, all that is going to be, counted towards the gross income. Farm income, unemployment compensation, Social Security benefits, and other income.
Yeah, and I was going to add to that, David, that there's typically two kinds of income. There's an income that's an earned income, which is your wages, commission, and then you have to report any other income that is called unearned income. Mm-hmm. Okay, and that, like you said, is the dividends or interest from your bank, okay, or your rent if you have a home that you're renting out, alimony, winnings, and royalty. Also, there's a non-taxable that are gifts, inheritance, child support. So there's a lot of income going, to
that must be reported
to the 1040. But mostly, it's mostly earned income that people,
for the most part, your W-2, your 1099
correct.
For the most part, unless
Correct.
people have like dividends, etc. Perfect. So now, as we said earlier, so that's the first part of the tax form. It'll calculate your gross income. Now, obviously, this form doesn't calculate the tax liability using the gross income. Let's make that very, very clear. So what it does, and I mean, I don't know the history of taxation, but I'm sure over the years, the changes were implemented so that now as we understand it now, gross income then has a series of adjustments, if you will, that are going to basically produce an adjusted gross income. So we could say that the tax bracket or the tax percentage is not applied to the gross income, but to the adjusted gross income. I said, again, in the first stage, as we said earlier. So how do we get from the gross income to the adjusted gross income, lines 23 to 37 in the form?
Okay, there are adjustments with, for example, educator expenses. If you're a teacher, you can deduct $250 of educator expenses. You also have moving expenses, self-employment taxes, and others like that.
Mm-hmm, mm-hmm.
There's also the student loan interest. That is also an amount that can be deducted from your income.
Okay. Educator expenses, certain business expenses. How about health savings account deduction? What is that?
That's the same thing. If you contribute to a health savings account, that part is also deductible. Okay. There's a limit on that, up to $5,000 for a person.
So basically, the government is saying, look, if you had these expenses, let's deduct them from the gross. I don't want to tax you on those amounts.
Exactly.
Is that what the spirit of the law here says?
Right,
yes,
exactly.
I don't want to tax you on everything that you included in gross. That would be gross, right?
That would be gross.
That would be gross. So let's make some deductions, and I'll allow you to deduct some of the educator expenses. Now, there is something here, the self-employment health insurance deduction. The self-employment health insurance deduction. I understand that if somebody's self-employed, if they pay for insurance, what they pay for insurance, they can deduct from the gross income. Is that correct?
That's part of the expense.
That's correct.
Yeah.
Yes.
As opposed to somebody who is employed.
Correct. They have more benefits.
Right.
Being self-employment, you could deduct the whole amount of what you spent.
So being self-employed has that quote-unquote advantage, right?
Exactly.
Perfect.
And then when you're self-employed, you also have to pay taxes, okay, for self-employment tax, and half of that is deductible as well in the adjusted gross income.
So student loan interest deduction, tuition and fees, domestic production activities deduction. So there are certain amounts that the government says, guess what? I don't want to be gross. I don't want to tax you on everything. Let's deduct those from from your gross income, and that becomes then what? The adjusted
The gross income.
Gross income. It's also known as AGI.
Right.
Are we on the
Correct.
same page?
On the
Yes,
same
we
page.
are. Yes, you're correct, David.
David, there's also one important thing is Social Security. That comes into their income. And it may or may not be taxed, depending on whether income you have.
Let's briefly say, so depending on your combined income that a
Right.
person has, and we're talking about those that receive Social Security,
Yes,
of course.
exactly, of course.
The combined income, if it reaches a certain threshold, then a percentage of that Social Security would get taxed.
Exactly. For example, what they do is they take half of the Social Security income and add the other income, and if it's over for a single person over $25,000, then that might be taxable. Only that part of it.
Right.
But it's not taxable in the Arizona state. But we're not talking about the Arizona state.
So you have to be really careful on
Yes,
your Social Security.
yes.
You could ask the Social Security Administration to take income taxes
Exactly,
from
exactly.
there in order to recuperate that
Yeah, 'cause
tax liability.
A lot of people are surprised. They say, well, why am I
Yes.
paying taxes on Social Security? I already.
Right.
But that's
It
a
is
reason. That's a
possible.
reason. And for a married couple, it's 34,000.
Okay.
Anything over 34,000.
Perfect. Okay, so in line 36, or actually 37, it says subtract line 36 from line 22. So basically what it does is, all right, good enough, the government would say. I already gave you breaks here. Good enough. So use those credits, if you will,
Right.
and deduct them from the gross so
Exactly.
that you get your adjusted
Gross income. Exactly.
So now it doesn't sound too gross.
That sounds so bad.
So the government is not going to tax us on the gross amount, right? Perfect. So now we come to the adjusted gross income. I said earlier that in a certain sense, the adjusted gross income is the taxable amount. It's the taxable amount but not the final.
Right.
Because,
Right, you're
because
correct.
and again, I have to believe that in the history of taxation, somewhere along the line, this is, wait a minute, let's offer more or further deductions or credits, right? Even to the adjusted gross income. Frank?
Right. Yeah, exactly. And what that is if you have enough itemized deductions, that comes off of the adjusted gross income. Okay, but there is a standard deduction for depending on whether you file it separately, single, married, or jointly, and you can use that amount, or you can use the itemized if it's more, and that comes off of your adjusted gross income.
Okay, let's tackle that. So we know that some expenses, the government says, you know what, I'm not going to tax you on that. So even when we produce the AGI, the adjusted gross income, there are still some
More deductions.
that the government
Correct.
allows. And you just mentioned one. Here's where the standard deduction or itemizing goes.
Exactly.
At least that's one of them.
Exactly,
Correct.
that's one of them, right?
Now let's explain this, because a lot of times, like I've tried to itemize for the past 5 years, and it doesn't do me any good because the standard deduction is
Beats.
higher. Can
Correct.
somebody briefly explain that concept of either standard deduction or itemizing?
So, David, when you itemize your deductions, you're actually listing those expenses that the IRS, the government, allows you to use to reduce your taxable or to reduce your income to get to your taxable income. These things include interest on a home mortgage, and that's usually the largest one.
Right.
And I think because the interest rates have been so low on mortgages, that's kind of left people to be able to claim the standard instead of itemizing. Some other expenses would be medical expenses. But again, those expenses have to exceed a percentage of your total gross income.
Can you elaborate just a little bit more before we go on our second break? We have about a minute max.
Okay.
On that, the health deduction.
Yes. So when you incur medical expenses, you can deduct those once they reach a percentage of your gross income. Once your expenses exceed 0.5% of your gross income, then you can deduct those medical expenses.
Yeah, because a lot of people have the a wrong concept that is it's all medical, but if it doesn't exceed 7.5 of your, again, what? Adjusted gross income. Again, adjusted gross income, you will not be able to include it.
That's correct.
So a lot of times you're going through the whole, what is that Schedule A?
Schedule A,
So
that's
Schedule
correct.
A, and then you realize, when you use it, when you do it via electronically, the computer does it for you, and it says, okay, this is what you come up with, itemizing, this is what the standard deduction is, which one would you like me to use, right?
That's correct.
And of course you're going to say the standard
the larger
deduction, if
amount,
it is,
yes.
especially come next year. When we file taxes for 2018, the standard deduction for a married couple, it'll be $24,000 plus. Right. So basically, it's going to be even tougher
to meet
for
that,
the
that's correct.
itemizing to apply. So if somebody does itemizing and the amount is higher, then of course they're entitled to use that amount.
Yeah, exactly. And some of the other deductions are like gifts to charity and stuff like that. So a
Right.
lot of people are worried that, okay, I'm going to be $24,000. I don't need to give any charity because it's not going to mean anything.
It may
So-
it may impact in the decision-making
Exactly,
process of
exactly.
someone who was given to charity because they could deduct it. Now,
Exactly. Now they're gonna say,
I'm
forget
not- Oh, that's not so good.
But no, yeah, it's not good. That is gross.
Yeah. Okay. We have to go on a break. You are listening to AARP, Arizona Hispanic Connection. The subject today is Filing Taxes 101. Stay with us. We'll be right back.
Welcome to AARP, Arizona Hispanic Connection. Educate. Celebrate. Connect. Arizona Hispanic Connection.
Thank you. Thank you for staying with us. This is AARP, Arizona Hispanic Connection. We have three guests with us today, and all three of them are retired. All three of them are. So that means you retired, but you didn't go to sit down and go to the beach or go to Rocky Point.
Not
or-
at all.
We work more now than before, I think.
Yes,
I
think
hear that
so.
a lot from people that retire, that they work more. So, thank you so very much. Not only that because you're volunteering, but because you're volunteering with the tax aid programs.
Correct.
This requires a certain level of learning and devoting more time than other types of volunteer opportunities. So it's not an easy one, and you took the harder one. So thank you so very much.
Okay, you're welcome, David.
Thank you. And a couple of you are with the AARP, Arizona Tax Aid Program, and
Right.
then you are with VITA. Again, we are following kind of like the form of the tax form 1040, and the whole point of taxes is to get the adjusted gross income as low as possible, because that's going to be used to calculate how much
Right.
tax you owe. Let's stay a little bit more on this item that affects the adjusted gross income. So what we said that the exemptions, and we said that taxable income, the alternative minimum tax. There's several items that allow the adjusted gross income to even be reduced further. Correct?
Yes, there is. And the second item would be child care and dependent care. That if you have a child in a daycare, you could deduct that also. And then you have an additional education credit also on this part.
These are non-refundable credits.
Okay.
Okay, so after you take your exemptions and your standard deductions, if you have zero tax liability, these you cannot use. In other words, they don't add.
Oh.
Okay, so
That's
they're not
important. Repeat that, Frank, please.
non-refundable credits.
So non-refundable credit means that if there is no liability,
Exactly.
you will not be able to
Right,
apply them.
exactly. Which is okay. I mean, I guess in a way, but
Right.
because you don't know anything. But it's a non-refundable. A lot of people have a lot of problem with that because some of those are like the residential energy credits when they buy. They expect to get thousands of dollars because the energy credit, and it turns out probably won't be able to get anything if they don't know, if they don't have a tax liability. That's important. That's a non-refundable.
Okay. Now, when you help people to do taxes, let's use a couple minutes. What is something that you notice that when people come in, do they come prepared? Do they know pretty much what they need to report? Do you need to remind them? What is the experience like?
I've had both. Those that have come year after year, and they know, they come prepared. But then we still have those that walk in for the first time and are not prepared. So we have to educate them and show them, teach them, so that they will know what they need to bring. And quite often they have to leave and come back another day. But it's better for them, because if they don't come prepared, we cannot prepare an accurate return. We had someone who came in the other day and said, I think I'm missing a W-2 form, but I want to go ahead and file. And we're like, no, we can't.
Right.
You need to have all your W-2s.
Yeah, I was going to add that to that. When you come in, when you come into one of our sites, there's an intake that is being taken from another assistant, and they need to know all the information before you go and see us as a tax preparer. And most of the things that you will need to bring in is your photo ID, social security card, and your W-2s, self-employment amount that you work, and health insurance, and mostly let's see here. If you have a copy of last year's return with you, but most important is your Social Security and identification and W-2s.
Do you see a lot of people being penalized for not having insurance? Or not so many cases?
Not a whole lot, because most that come with W-2, they're insured through their employer.
Got it.
So I've seen just a couple because they couldn't afford it.
Right.
So they say, well, I'll rather take the penalized than paying $600 a month for health insurance.
Right. Okay.
As you were saying, I think the tax aid, AARP tax aid, is a very good program, because we have facilitators. When they first come in, they go over all the paperwork, and these are just volunteers that say, okay, you have everything,
intake,
otherwise you're out.
yes.
Then we have a counselor that'll sit down, do the taxes actually, okay? And then we have a quality reviewer that goes over everything. So it's a very good program, and it makes me feel good because I know.
It's like a three-step process when you come in.
Yeah.
Yeah, and VITA has a very similar program. We do an intake first to make sure everything is
Correct.
there. They sit down with the tax preparer, and then we do have a quality review area that reviews the return before the taxpayer signs it and before they walk out with their copy.
I know it's not easy to give a website because they make this website so complicated. So a lot of times I just Google it. Just go and type in VITA or Google AARP tax aid. Because if you give like long names, it is so difficult for people. So if you have a computer, Google AARP tax aid program
Arizona
or
tax
VITA
aid,
program, and you will find them.
Or else, David, the IRS also has a
That's
website.
right.
It's irs.gov.
.gov, and then they can find sites.
Right, and they said you need help with your taxes in bold letters on their front page. So
Perfect.
you click on that.
Because of time, let's tackle a very important item, and that is, once you went from gross income to adjusted gross income, which is your taxable amount on the one level, and then you went to a second level where even the adjusted gross income is further reduced, then there comes a point where, all right, now let's apply the tax rate. And we know we have brackets in the tax rates, right? These tax brackets, depending on how you file and how much money you make, right, that determines what percentage of tax you will pay. Am I correct on that?
Yes, you are, David. And by the way, David, there's 7 tax brackets, depending on the amount that you earn throughout the whole year.
Now, one thing that is very important before we go on break that we want to explain is that once somebody knows, let's say a person married filing jointly, right? And they fall into the, say, 25% bracket. Does that mean that from 75 to 153,000, do they pay 25% on all the amount, or they pay a lower percent on
Exactly.
Okay,
Exactly.
can you explain
just
the
that
concept?
amount? Okay, so for example, like you said, 25,000, they would already pay 10,452 for the lower that, but then everything over 75,901, they pay 25% of that.
So they
it's
will
not
pay
the whole.
So in this example here, we would say that the first $18,000 will be taxed at 10%.
At 10%, exactly.
From 18 to 75,000 will be taxed at 15%.
15%.
And then from 75,000 to 153, it'll be taxed at
Right.
25%.
So you get three amounts
Okay.
that come up to that.
This is so important to understand because
Yes.
a lot of times somehow you think that, I belong to the 15 or 20 or 28 bracket, and you
Right.
think that the whole percent or the percentage is going to be applied to the full taxable amount, and that's not the case.
That's not
correct?
the case, exactly.
Can I add
Of course.
something on that, David? When you say different brackets, for instance, you make 20,000. I'm just throwing a number. The first 9,000, like you said, is going to be taxed at least 10%, and after that, when you reach your limit at your next 10,000, it's going to be taxed at 15%.
Right.
Okay.
That's actually good, isn't it?
Yes, it is. Yes, it is.
Because can you imagine paying, say, somebody falls into the 28% and the full amount of 28? That would be too much tax.
Oh, yes, of course. Yes.
So again, let's explain that. So you have your gross income. Then the government says, no, I'm going to give you some breaks. I'm not going to tax everything. So deduct this, and the other. So you get it from the gross income to the adjusted gross income.
Right.
And then that adjusted gross income, it's literally your taxable amount, but you are able to lower it even further. So you apply
Right,
other
correct.
adjustments.
Exactly.
And then you bring it down. Now there comes a point where that's it. There's just no more, there's no room for more deductions. So at that point, you find your bracket, and then you find your percentage, and we already explained that some of the amount will be taxed at a percentage. Then another amount will be at a higher percentage, and then the
Right.
remainder at the percentage or where you fall in the bracket.
And it's different for each individual taxpayer,
Right.
married filing, joint, the head of household. They're all different.
Yeah, so here's where the single filers, the amounts are different. Married, finally, jointly, or qualifying widow or widower is different. Married filing separately is the amounts are
Exactly.
different. And then the head of household. So again, this is important. There is a tax bracket. Everyone falls into one place in that bracket.
Depending on how you file on your
Right.
on your how you
Right.
file.
So everybody should
Yes,
know
no,
that, right?
cor-
Everybody should
well,
know.
not apparently. I mean,
It would be good to know.
Good to know, but most of the people out there
Right.
are not aware of that.
And then, David, that is a tax on your income. And,
Right.
Because now you might have other taxes that are going to be added on,
Such as?
such as self-employment tax if you
Okay.
have in business, IRA, if you pulled out money ahead of time, there's a penalty on that. First-time buyer credit, you got to pay back to $500.
Okay.
So it's quite a few others taxes.
So there are taxes that can be added to your liability.
Right, and they have no consequence as far as the income tax.
Okay.
But you still have other taxes. Okay, that's
Got it.
completely different.
We are
Oh,
going
the
to
healthcare. That's another important.
Okay.
If you didn't have healthcare, okay, that's a penalty.
It's a penalty.
So that's a tax.
That's
or
where
if
it
you
goes.
got right, exactly.
Okay, we're going to use the last segment to do the reconciliation.
Okay.
Here's where the refund and the payment comes in. So stay with us. This is AARP Arizona Hispanic Connection. We'll be right back.
Welcome to AARP, Arizona Hispanic Connection. Educate. Celebrate. Connect. Arizona Hispanic Connection.
Thank you. Thank you for staying with us. This is AARP Arizona Hispanic Connection. I am your host, David Parra, and we have Irene Gomez, Consuelo Alvarado, and Frank Varela, all volunteers. Again, I'm so inspired by volunteers. Actually, at AARP, we have nationwide thousands of volunteers, and I've learned so much from volunteers. and from staff as well. So it's great to be around you. Thank you so much.
You're very
You're
welcome.
welcome.
Before we go to the reconciliation concept, where one finds out or how people find out whether they owe or they're going to get a payment, can you use a minute, a maximum of 2, Frank, to say a little something about the self-employed? How does the self-employed fit in this concept that we're explaining? Pretty much the same with
Pretty much the same. It's not. It doesn't go into a W-2. So a self-employed comes up as a business. So he's got expenses, he's got income, and then it depends on once he gets rid of the expenses, now he's got a profit that he's got to do, and then all those expenses are trucks, mileage, office supplies, and all that.
Okay.
But with the AARP tax aid, we have a limit as to how much we can do. If they have a $10,000 loss, then we won't be able to use them.
Loss?
A loss, yeah.
Okay.
If there's a loss. Expenses is $25,000. Okay, but it's all the profit. Okay, so there are limits, and that goes in. Excuse me. Since you got your own business, you have to pay self-employment tax for yourself, which is Social Security, Medicare, and all that.
And
So-
that is kind of tricky because I assume that a lot of times people don't want to pay too much of that tax and they report less. And that can be tricky because
can be tricky,
if
yes.
you don't report the amount that you actually made,
Right.
then that's going to affect you when you retire because you're not cultivating
Exactly.
a robust benefit.
Exactly. So you have to be real careful. So self-employment is kind of hard. That's why we sort of limit it because a lot of people use that to jack up their earned income credit.
Right.
The more money they make, the better earned income credit they get for their kids. So it's kind of tricky.
Let's do the reconciliation.
Okay.
So once the AGI, the adjusted gross income, has gone as low as it can be, then they will apply the tax rate according to where people fall. Right.
Exactly.
So then at that point, there's the reconciliation. So I understand that there are mainly two concepts here. Once they know the tax liability, then they're going to deduct from that the amount of taxes they already paid, correct?
Exactly.
During the year.
The whole year, correct.
And then are there any other credits that can affect that amount?
Oh, yes.
By all means.
Because those are now called refundable tax credits.
Okay.
The biggest one is the earned income credit. If you have kids, it all depends on your income, and that's all refundable tax credit. It could be up to $6,000 if you have.
It doesn't matter whether you have you owe or they owe you.
No. Now we've established what the penalty is, right?
Okay.
Or what the tax liability
so to
is.
speak.
So now we're going to add, and that's going to reduce the tax liability.
So
Okay.
these are credits that affect directly the tax liability, as
Exactly.
opposed to lowering
Exactly.
the the taxable amount.
Exactly, and these are refundable tax credits. So you
Great,
don't. Okay, so that's good because a lot of people, like I said, with the the EIC, the earned income credit, they get $6,000, even though they only made $20,000 for the year, and they had zero tax liability probably, but they'll still be able to get money from that.
Right,
So it's
right.
very important.
Now that I don't believe has changed with the reform.
No,
tax
no,
reform,
it has
right?
not. It has
so
not.
they kept the earned income credit.
Right.
The only thing that they did away with was the
The
exemptions,
exemptions.
and they
Exactly.
double the
standard
the
deduction,
standard
the
deduction.
Right, and then there's the additional child tax credit that you were talking about.
Yes,
Part of that at the beginning was non-refundable, right? But now
You're gonna
the
get
other
some
portion of it
portion.
is refundable.
What is the additional tax credit?
Oh my! They
For a
calculate.
child.
They calculate that somewhere with I don't know,
Yeah.
Frank.
Yeah,
you know,
it's
that
somewhere.
they calculate and then whatever they think for a percentage also,
Right.
and I don't know what the percentage
It could
is.
come up to $1,000 per child. Okay.
Okay. So where is that calculated?
At this point,
the end?
okay, there is one calculated where we're talking about the non-refundable. Okay, if
And
you
the
don't know,
refundable.
and then the refundable. So part of it, if it's non-refundable, you can still have refundable as a payment. Okay.
So if once the tax has been calculated, let's call that the tax liability.
Exactly.
Then you deduct any payments that you've made during the
Exactly.
year, and that's going to be on your W-2, correct? The W-2 will have the amount of money that the government withheld.
Oh yes.
And then you will apply any credits that you have.
Exactly.
And that has a more direct effect
Exactly.
on the taxable amount.
It's a direct effect. There's no.
It's not necessary. It's not It's not computed into the whole form.
No.
But it affects actual amounts. Affects the tax.
Yeah, this is how much.
Liability.
Let's say, for example, after you do all the tax liability and all that, you're going to get back $100. Okay, after you, and that's just on income.
Right.
So now, if you have these other credits, let's say it's another $2,000.
Right.
So now you're going to get back $2,100.
Right.
Okay.
Right.
So it's all added at the end.
So that's why I call that the reconciliation.
Yes.
Place where you have calculated your tax liability, then you deduct your payments that you've made during the year.
Yes.
And then if you don't have any credits, well, that's the end of it, right?
That's it. Yeah, that's it. Yeah, you don't have any. Yeah.
No,
That's right.
I was going to add something to
Sure.
the child tax credit, and that is under the age of 17. And you do have a phase-out limitation, which is
Yes.
really, really high. And
Right.
that's, I guess they start to phase that out at 200,000.
I think yes.
Okay. Just two.
Yeah,
you
no,
know,
just the other one.
and-
And the other one is the American Opportunity Credit. If you have kids
Correct.
going to college,
Correct.
you get up to $2,000 of the American
25,
Opportunity.
2,500.
2,500. Yeah.
Yeah. Now, can somebody say just a little bit about the schedules? Because the schedules are always part of the 1040, not in every case,
Right.
but in some cases. What is the concept of schedules?
Okay. Well, schedules typically you go out to a schedule, you calculate based on that, like itemize Schedule A, come up
Okay.
with a total, and you put that into the 1040. Either that or the standard deduction. Okay, it's
so
a final
schedule-
total.
A schedule could be considered like a place where you report and then do
A worksheet.
a worksheet kind of thing.
A worksheet,
and I
exactly.
downloaded several. Like the A has to do with itemizing to see
Right.
if it's better for you than claiming the standard deduction.
Mm-hmm.
The interest or dividends, profit or loss. This is
Exactly,
for business.
exactly.
Capital gains and
Exactly.
losses, that would be Schedule D.
Right.
Supplemental income and loss, that would be Schedule E.
Right.
Profit or loss from farming, that would be Schedule F.
Right.
Fundraising or gaming, even gaming.
Even gaming. If you have gambling winnings, okay, that is taxable. It goes into line 21, which is other income.
And there's a form that they gave you, right?
No, yeah, they give you a W-2, what is it?
Something
WG, I think it is.
Yeah.
Okay.
And then you have to report that. And then also, if you itemize, you can take up to the amount that you won. You can itemize and deduct that as an itemization. If you itemize. If you don't, then you got to pay tax on the whole income.
Now, there's a Schedule H, and it says household employment taxes. Have you heard of that one? I believe that's if you hire somebody
Yes.
at home. Then you have to pay their Social Security
yeah.
and Medicare tax. Now, in addition to then doubling the standard deduction for 2018, this is the tax reform
Right.
for President Trump.
Right.
Then we will see reflected next year, right? When we
Right.
file taxes in
Exactly.
2019 for 2018, that's when we're going to see that reflected.
Yes, Dave.
Right.
Now, another thing is that the tax brackets change.
Yes.
I saw mine, and you will not believe it, but I only gained 1%.
You do.
I only gained 1% with this change. They divided the brackets differently, so you
Differently.
will fall in different places, perhaps, than you did in 2017.
Exactly.
It's a lot lower than the tax bracket that we have now. At least about 2 to 3% lower for 2019, which is better. You know.
Okay, we have come to the end. Any final thoughts? Anybody? I don't know if you want to make a call again for volunteers or any final thoughts.
One thing that the real concerns us is that people say, should I file taxes? Okay. And
Especially retired folks?
people, yeah.
Okay.
And what we have to say about that is it's good that they come in because we'll file electronically. And if there's any identity theft, we can find it out that way. Plus, for the state of Arizona, there's credits that people that have there's a $25 increased excise tax credit. There's a property tax credit up to $502 that they're eligible for, that if they don't file, they're not going to get.
Yeah. I want to thank each of you for making time. I know it was early, and really, really appreciate it for making time. And we hope that you found this program very, very entertaining, informative, and engaging. Thank you so very much. This was AARP Arizona Hispanic Connection. Have a great week.